Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants. This podcast is for entertainment purposes only and is strictly not intended as financial advice. Any opinions are general in nature and do not take into account your personal circumstances, needs, or objectives. Securities mentioned are for illustration purposes only, and this podcast should not influence investment decisions. You should read the relevant PDS and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future returns. Podcast guests and their clients may hold positions in the securities discussed in this podcast. All right, we're live. We've got a full house. Lots going on in the world at the moment. All right, so what should we talk about today? We've got good news. We've got CPI numbers just released overnight. Everyone's worried about inflation again. We'll talk about some stocks. AVA, we had a question through. We had a couple of questions through on AVA, one that we've talked about before. We might get it to a couple of others and, answer a few of your questions. But maybe to kick off a couple of bits, I'll be very quick on the good news. This week, two of them, which I thought were cool, that I picked up was an enzyme used in laundry detergent can recycle single-use plastics within 24 hours, and a super gut made from a superworm's microbiome devours problem plastics. Yeah, I just think it's a really cool area of synthetic biology that we're getting into, where we can solve a lot of material problems with these synthetic biological inventions and stuff like being able to eat plastic. I think it's very cool.
I think it's really cool. I feel as though I've heard this story before, and several times over many, many years. I wonder if it's one of those things, it's like there's some encouraging lab results, but they've just not managed to scale it, or there's some cost dimension to it that makes it uneconomic, or
you could be right, man. I mean, it does sound like one of those early science ones, like the super solar panel thing, doesn't it? Yeah, that's fair. I do think it is pretty early and all that. I've heard other things like ocean plastics, enzymes to eat them, but it's been able to deliver that at scale at a cost-effective way. That's a bit harder. So that's a fair one. What about you guys? Any good news to drop in? Otherwise, we can get on to the...
I've got one for you that I saw. The Times report welding method drastically cuts time to make mini nuclear reactors. Sheffield Forge Masters uses electron beams that reduce the process from 150 days to 2 hours. I did think this was good news because I think that the energy situation can be improved by nuclear if they do actually, which hasn't yet been done, but if they do actually crack the small modular nuclear reactors. Now, there was a high profile project there that hasn't been going so well. So it's a long way, but I thought that is a really positive step because it shows the manufacturing process can reduce the cost over time, which I think is a core tenet of nuclear playing a bigger role in grids. And with nuclear and renewable energy, I think we could have a much more distributed grid with the generating source much closer to the centres where it's used. And that would overall be good for Australia. For example, the recent blackout in Victoria, typically, or every blackout, some people just want to blame renewable energy. Actually, what happened,
people blame whatever the opposite of their side is normally, right?
Yeah, the transmission lines to the biggest power plant, which happens to be coal, but the biggest power plant, that's the relevant thing. The transmission lines to that got broken, so that, for safety reasons, tripped off, and then suddenly you lost 30% of the power there. So that's going to be the case whether your big central generation is nuclear or coal or hydro. If you have a sudden knockdown the transmission lines, that you're going to face consequences. And the way to minimize that would be to have more generation sources, more spread out, smaller. And I don't think you can completely do that very quickly or easily. But hey, renewable energy and small modular nuclear reactors would both be good in that regard.
Can I say on behalf of the government, if it's not quick and easy and shallow, I'm not interested, right? If you're asking for me for some deep, considerate, long-term thinking, you come to the wrong place. Let me just tell you that right now. Disavow you of any sort of notion of a contrary point of view.
I think it's great news on the small modular. I want to get into the politics of it. I think I guess my only other 2 cents, I'm actually less excited, less interested in small modular. The more I dig into big traditional nuclear, I think could solve the problem. And I feel like it has two image problems. One is that it's kind of sexy when you talk about something new. It's it's a rebrand and away from all the scary Chernobyl fears of nuclear. But if you look at a 4th gen modern nuclear plant, you basically just design it once and then build it for Australia 50 times. You'd solve a lot of the energy problem. So I think you can have a lot of the benefits that we're trying to get from modularization just with existing designs, having one design that you build 50 times versus every nuclear project being this bespoke, white elephant of red tape. Yeah, so
we have more learning by doing that as well. Like there are more programs that have done that you can try and copy and improve on as well.
Yeah, like France rolled out quick. China's doing a lot at the moment. So yeah, I think there's things there. I'm not against small modular. I'm less needing it, but no, a very good one. And actually, maybe we'll segue there because it's one of our questions today was about nuclear. Let me just pull up the question. So it was, hi guys, thanks for the pod. I'm looking at really looking forward to listening every Friday. I was wondering about your opinions regarding the present uranium boom and an ASX-listed uranium company, Boss Energy. I was lucky enough to buy and hold shares for more than a year now, so I'm getting close to a 3x return, but the valuation seems too high to me, 84 times PE ratio. I'm thinking that it might be time to sell some of them, but I do not want to hurt myself in the long term for some short-term gain. What do you guys think? Is there still enough room to grow for this company, i.e. even with the possibly elevated uranium price levels caused by the potential uptake of nuclear energy to tackle decarbonization? Can the stock go much higher in the long term? Ideally, I would like to be a long-time retail investor holding stocks for 10 plus years, which led me to hold on to some dogs, but that's another story. Thanks and keep up the great work. Cheers, Z. Just maybe, whether you want to dig into Boss or uranium in general, if you guys have any thoughts on either of those.
I'll say on uranium in general is that we are for sure like in a more advanced part of the hype cycle around uranium right now. Like now I don't know about the valuation of this stock and it's definitely not a comment on this stock. But I would say from a sociological perspective, if you're considering this company speculative, well then a speculative company is definitely going to be influenced by, I guess, the hype cycle that just plays out time and time again in different industries. We're also in an AI hype cycle right now. And uranium is definitely in the hype cycle and it's not right at the low point. I don't know when it's going to peak and I couldn't pick it better than the next guy, but we're definitely not at the bottom. I would say that much. So when you have a speculative stock and now you've bought it when the hype was lower and you've ridden that sociological wheel, good times pass away, but then so do the bad. Like for all of these things like AII, we had it a few years ago, crypto, uranium, blah, blah, blah. There's always a flavor of the month. There has been a sociological cycle that you've benefited from in uranium stocks. Lithium has happened. We've seen it play out as well. So because of that, I would say, with speculative stocks, it's legitimate to consider the sociological aspect of what's going on. And also, like, my experience with speculative stocks is this is not a specific comment on BOE, but it's just generally speaking, if you're on a multi-bagger on a speculation, my experience personally has been that, it's probably wise to at least take something off the table so that you don't lose everything when you would have had this great opportunity. Having said that, not a comment on any specific stock, not actually familiar with any mining companies in any great detail. So this is more just talking about sociology and speculation.
I'm trying to work out where the PE comes from because as far as I can tell, they don't make any sales. Certainly not in the last quarter. So maybe there's some grants or something that's there.
They had some like inventory that they might have sold down to make that over outside that last quarter. But you're right, there's no revenue in the last quarter on an operating basis that I could.
So this is analysis on the fly. So you've got to take this with a grain of salt. And the edge, obviously, in investing is knowing more than the rest of the market. So this is by no means sort of canon here. But it is a business with a long history of incredible share dilution. The share count's doubled in the last 3 years. Go back and look at any previous year's statement. They're always gonna we're about to do this. They're trying to develop this big tenement somewhere. It looks very exciting. I don't have any reason to doubt that it won't be. But these things are sort of valued based on some core samples and a bit of geology and then a whole bunch of hope. and what the market is going to be like for that product when they are ready to produce, we don't know. What the actual production will be, we don't know. They don't know, right? You don't really know until you start kind of doing all of this kind of stuff. And in the meantime, just again, I'm only simply referring here to the last December 23 quarterly statement here. They're burning through $1.6 million per quarter. So what do? I don't know. I mean, I'm not giving it a good rap, but just to be balanced here, there's every chance that they get this mine up and running. It starts producing extremely good quality product, which is in high demand, and their sales go through the roof. And this thing looks like an absolute steal. Like that is absolutely possible. But that's what I would be looking to answer as a shareholder. How likely is that? What kind of revenue is this resource likely to generate over its lifetime? Maybe discount that back in some reasonable way at a margin of safety and see where it lands. But I would know that statistically, these situations don't usually work out, particularly as Claude said, after a lot of hype has sort of been pushed into the price.
Yeah, I have no idea on this particular stock, but the point is more. I also would disaggregate the idea of being a long-term investor with always holding stuff. I think that it's possible to be a long-term investor and you have certain companies that you are committed to being a long-term holder in, and that can be painful. And you've identified some, and you'll get them wrong occasionally, even doing this. But I think it's possible to be like, okay, I have certain long-term companies that I'm just going to hold. And then you have other companies that you might try and, just develop more of a plan around if you do get lucky, rather than just always holding everything to the end of, forever.
Just to add to that, I think it's more the intention. I'm intending to hold forever. Everything I buy, I intend to hold forever, because if all goes well, that thing is just a compounding machine that just, spits out cash and reinvests it at insane high rates of return. So that's the intention. But when it doesn't turn out that way, and it won't very often, then you can sell. You're still a long-term investor. The intention was to hold. It just didn't work out that way. So I'm not saying this of the listener, but I know a lot of people go, oh, well, I'm a long-term holder, so I'm going to continue on with this dog that, the thesis is clearly broken. And the reasons that I bought it for are no longer valid, but I'm a long-term investor.
That's definitely not
dangerous.
This is definitely not what's happening here, though. Like, this is definitely the winner. This one's gone up really well. And so, yeah, it's just like, unless, for all we know, the whatever confluence of factors has caused this share price to run up so well over the last few years, that's still in place and it's playing out. So I wouldn't poo-poo it in any way. And because, as I said, a mining uranium company is way outside my area of knowledge. But I do definitely think that, I wouldn't generally associate an earlier stage mining company with something that I would think of as like a long-term investment. I'm probably leaning towards a very, very, competitive advantage style, profitable businesses for the for the long-term holdings, and the businesses that are so good that the debate is more about how much a profit's going to grow, how much bigger profits are going to be in 5 years or 10 years, because you're inevitably going to be paying for a price that implies some degree of profit growth. And then for the long-term investments, you're more taking the overs in a way, and that can be an advantage as a retail investor, because you're like, yeah, everyone that's pricing this on the market is using a 5-year model. And I'm going to say, well, actually, I think years 5 to 10 are going to be really good as well. And that's where you can get your edge. And that's why retail investors can make great money off stuff like just real stupid things like buying shares in Google. Classic move. Does pretty well. I own shares in Google, of course, by disclosure. But like, I don't think you really need to think that much more about it than to know that the financial world's modeling Google for the next X years. And if you're making the call that you think the next 2X years are actually going to be great for Google, that's probably where you can get outperformance.
Yep, I think those are really great points. It's kind of like beating the fade rate, as they'd say. Like, if you can keep growing years 4, 5 plus. I was just chatting about that this morning. But yeah, to come back to uranium, I guess first is I do agree with the premise that there will need to be more nuclear energy if we're going to decarbonize. I think I've talked about that a fair bit on the pod, but it is more and more convinced that is the case. If we want to do it, it has to be a big part of the mix. So that sees some long-term demand, but you need to match that up with supply. And I guess what you're seeing, so, Boss doesn't have production at the moment. It's bringing it on soon. And you see that actually from a lot of so maybe I'll focus more on the listed uranium companies in Australia, because a lot of them are in that situation. There's not a lot, although prices have been really high, there aren't really any that are printing cash during this period. They're all their shares have rallied because they're in the uranium space, but they're not actually benefiting at all from these current higher prices. Like, they're benefiting from the belief that those prices will stay high when they do actually start producing. And Boss is one of the ones that'll be
exactly like lithium.
Well, it is. Yeah, exactly, Andrew. Actually, it's very similar to lithium. And I remember during the lithium boom, people
similar, but at least lithium had some that were printing some cash, though, right?
Yes, yeah, and some that weren't, though. But yeah, some. I remember during the lithium boom, I was going to say some talking about how much the NPV of this business had increased because of current prices. It's like, well, prices now are down 80-90%. And that's the flip side is exactly as Andrew's alluding to, is the supply side. And so that's actually what you saw a couple of weeks ago. I think it was when Cameco came out, and they're one of the biggest uranium companies in the world, saying, things are great and we see long-term demand. We're going to increase production or put on some new supply, and that kind of sent markets down a little bit. They're still elevated from last year. But that would probably be the more medium-term concern, is how many companies are trying to meet this this need. I know that there's a lot of talk of the long-term supply, but just how quickly can you have an immediate response? Inventory held on the sidelines, blah, blah, blah. Yeah, and then I think the last point is just, I guess layering on what Claude said. So the hype cycle then has a layer which is there's like the hype in the share prices, and then behind that is the kind of investment capital cycle where you just get all this money flowing, and there's a lot. It's very easy to fund new uranium projects when the prices are high. That brings on more supply, and I don't think that we're at the stage where lithium was, because there was just so much supply coming on and everyone thought it was inexhaustible and we could never supply enough. And I don't think we're quite there, but to Claude's point, we're not at the lows either. And I like that distinction Claude made, where there's some stocks that you want to hold forever and some which you would probably trade. Like if I'm investing in the capital cycle, I want to be really clear about where I am in the capital cycle, and how is more funding entering or exiting the industry. And you want to be buying when stuff is at the nadir ideally, and getting out before things get to the stage where everyone's bringing on new supply, because that is a very short time between there and when prices crash. And when prices crash in commodities, they can crash pretty hard. Again, uranium hasn't had any of the run up compared to lithium, so I'm not saying it's the same thing, but it's just something to keep in mind. So that'd be what I'd be weighing up. And yeah, looking at the cash flows. If these businesses were generating heaps of cash over the last 6 months, they would be de-risking your investment. You'd be talking about a cash multiple. I think that's where capital cycle stuff gets more interesting for me. But yeah, with the caveat that we're not deeply into these businesses. I've looked at all of them on the ASX because I'm interested in uranium, but we're not like deeply across them. And obviously none of what we say is investing advice. So yeah, have everyone run.
Hope it helps.
Cool. Well, maybe we jump into some macro stuff, because there's something I wanted to chat about, or I sent through to you guys before anyway, which was from Marco Papic, which I just been reading his book, Geopolitical Alpha. He put out kind of a special report about regime change in America. And the news that's just broken is the inflation numbers overnight, recording this on Wednesday, which were hotter than expected in the US. Maybe I'll touch on those first. So the inflation numbers came through not much different. It was 0.4% versus 0.3%, but kind of 0.4% per month. If you did that every month, it would mean your kind of core inflation was running at more like a 4.8% level. And that's obviously a fair bit above where things are targeted. Obviously, you have to do that every month. But what was kind of even higher was the core services, which was 0.8% month over month. And, you could annualize that to over 10% a year. I think those two together, it is an increase. I mean, I guess we'll see whether it's just a temporary uptick in inflation or not, but it does mean that the kind of Fed's ability to keep or to cut rates or stimulate the economy, etc., is restricted if we have this uptick in services and core inflation. And so that's something to be mindful of, because the markets, as Andrew was saying just a few weeks ago, everyone had baked in really aggressive rate cuts, and he was expressing some caution, I believe, Andrew, about how when everyone believes the same consensus, how that can be a dangerous spot. And we're kind of seeing overnight with some of the falls what can happen when just one print goes the other way. Yeah, so that's one. And maybe I'll just give an intro to, I'll throw that up, and I'll just mention the kind of clock tower research from Marco Papic. So his report talks about regime change in America. So a Trump 2.0 presidency, he says, will disappoint investors, whereas Trump 1 kind of pleasantly surprised them, because this time around, Trump doesn't want to drain the swamp. His most articulated policy is a deeply legalistic endeavor to rein in unelected technocrats in DC. So his second term will be more around an anti-bureaucratic revolution. He's also likely to come to power with a unified Congress. And so investors should expect loose monetary and fiscal policies, is what he's saying.
Absolutely.
Which will be very 100%. Negative for bonds, because and bearish for USD. And he says, what about equities? He says, we're not sold Trump as positive for equities, because if bond markets go up, interest rates go up, or bond prices go up, then that means all these long dated kind of the duration thing, what we saw in 2022 is the kind of potential for 2025. And just to unpick that a bit, because I do think he's onto something here. He's bullish up until November 6th, up until the election, because he believes that I guess you'd say the establishment, if you want to be conspiratorial, we talked about this before, the Fed, Yellen, everyone will want to keep the economy going really well up until then to give Biden the best shot of being elected. Whether you think that's good or not, you might think Trump's an existential threat to democracy. Maybe you like the guy, but that's kind of his view of the incentives behind the scene. And so after that, though, what I think he's saying the narrative is, at the moment, markets have kind of been fine with America's increasing debt. With Trump, you're going to get someone who's very clearly not worried about spending more and forsaking the long term, and that there could be a revolt from the bond market. Basically, suddenly all the bond investors will actually start worrying about the long term. All these times when certain people on Twitter have brought up long term sustainability, I don't think that's really been the driver of why bond prices run up, but that could be what happens in 2025. I think that's what Marco's saying. But Trump will want to spend a lot of money, could see bond prices go up, which is not necessarily good for the stock market and really bad for bonds, obviously. What do you guys think?
I agree.
I jumped a lot. Yeah.
Can I subscribe to the newsletter? I 100% agree. Just so many things to touch on there, Matt. Firstly, I can't believe anyone still says with a straight face that central banks are non-political entities. Of course they are. Can we please just pretend, we're all adults for a second? They are, right? Whether it's implied or direct or whatever. So that's just how it is.
I guess with Trump, it's also so polarizing where people people who are against him literally think it's more like bringing in the next dictator, right? And so you kind of think, let's say that you are not political 95% of your life. Maybe you would be political if you think you're trying to stop the next dictator, right? That's a moment where they would cross some boundary. So yeah, either way, just to add some more weight to what you're saying.
Yeah. Yeah. And so the debt has always, you can go back to articles in the 90s, which talk about the unsustainable fiscal footing of the US. And it was always, well, it's okay because we are the reserve currency and no one have any concern whatsoever that we're going to default on it. We'll figure it out. Mum and dad are around the kitchen table, the credit cards are all maxed out. Kids are going, how are we going to, don't worry, we'll figure it out. And that can has been kicked down the road. But when you're getting to a stage where the annual interest bill is $1 trillion, with a T, just to be clear there, and is compounding away from them. So they just physically can't issue enough coupons to cover that. You're borrowing to pay back borrowings and interest on borrowings. And again, there's nothing what I'm saying here that isn't just math, right? So I don't see how that's a controversial statement. And I feel as though that narrative is definitely changing. So, and then you throw someone into the mix like Trump. Let's be real here. Whatever you think of the guy as a politician, he's a failed businessman. I think I remember reading once, if he just put his inheritance into an ETF, he would have had 10 times as much money. But he's going to spend insane in a very populist fashion on anything that he feels that he will give him the love of the people, and the long-term consequences be damned. I don't think that's either a reckless statement to make as well. So yeah, things are going to get real. And I can tell you from my personal view, and I know Keynesians will disagree, but I just think when you pump a bunch of extra cash into the system, it's not going to be good for inflation. It's just not, right? And it's going to be one God almighty mess, I feel.
What do you reckon, Claude? Do you have any thoughts on that? The inflation picking back up now, or just that kind of longer term view of what happens in Trump?
To a degree, I feel like an ADHD boy sitting at the adults table. I don't really know what's going to happen. I guess my view has been... So first I thought there would be more of a recession or sooner than there was, but I was right that interest rate expectations would come down. But then we had interest rate expectations come down, but not much of a recession, which has obviously led the rebound in what's loosely called quality stocks, which happens to be the thematic that I overweight, not because I can time the markets, just because they're the ones that I don't get scared about, or that I can convince myself to hold on even when I feel sick. And obviously in hindsight, you're I should have, tripled down on Ordinate or something, which I don't own. But the point is that some people do it. And, ideally I'm invested in their funds. And at least when I miss things, I'll benefit from it that way. But quality rebounded, which I didn't foresee. But that kind of rebounded because there wasn't a recession, but interest rate expectations went down. I guess my gut feel the whole time has been that the bit that has been wrong is that interest rates will come down as fast as people think. So I've been overly cautious this whole time, which luckily what I do invest is pretty high beta. So it kind of comes out in the wash. But in an ideal world, I would have been longer what are my biggest holdings, or at least actually the big quality, because small caps haven't really smaller stuff. The money hasn't flowed down there. It's really just been the big quality stuff. So luckily, I have a couple of those in my portfolio, but really I should have just been 100% in those because they've been the easiest place to be. And which is why they're the kind of stocks that I think of as the never sell stocks, because they are usually the easiest place to be. But the problem is that the rebound has been led by this idea that interest rates are coming down, which the latest data you're suggesting and the markets are suggesting by selling off a little bit, this looks like it's maybe not coming down as much as we'd hoped. That's why oil has been pretty weak. So overall, I still think that interest rates will be slower to come down than they have been. I have to say, like, I still trying to tilt my portfolio more, except for like idiosyncratic ideas. As a general theme, I remain in that mode where like I often think of adding another company partially because, well, I see this one as a company that does okay with higher interest rates than are expected. So, I think I've got one that I'll talk about, is an insurance broker, which hasn't been the best performer, hasn't been a bad performer either. But I feel like maybe that kind of sector could be interesting in this if rates are higher for longer. At the same time, I've been looking at NIB, which I don't own, but like just the private health insurer. And I feel like maybe that's another one that, might be something that does okay if it turns out rates are higher than people think they're going to be. And that's kind of how I think. But at the same time, the magnetism of the quality growth stocks is too much for me to resist. And I'm glad I have some in them already. And I still probably want to keep adding to those ones over time, because probably the way I see it is ultimately when I don't have to write about, because I'm trying to be really aligned with what I write about. So it's really modified my behavior massively. But what I'd like to do is have a core quality kind of stocks that I think are pretty much long-term buy and holds, which I will invest in myself quite heavily. And then when I don't write about it, I want to do more of those, like what I think of as free money trades that I never have the guts to do as like in a recommendation official context. So I'm talking about step one, which I wrote an article about. I was like, I don't know the company well, but this looks like a massive setup. And sure enough, it has been. Another example, which I think we talked about on the pod, if I'm not wrong, was the ResMed situation when we freaked out over Ozempic. And like, I'm not like super across ResMed. It's a large company. I don't spend a lot of time on it, but it was just purely on that sociological thesis. Like, people are crying about Ozempic as if it's going to stop people being fat. Like, we're like 10 million steps ahead of reality here. And that's the kind of thing, like, I would happily, in my own world, if I didn't have to tell people about it live, I would happily like, YOLO 100K into that kind of idea, because I could then, if something went wrong or I changed my mind or new information came to light because I hadn't researched it properly, then I could sell it. So basically, that's the strategy I want to do regardless of anything else that happens. And whether rates go up or down, probably the only way it ultimately affects my thinking is my view that I kind of think that rates are going to be a bit higher than people think. That has so far probably punished me by being not long enough, those quality growth stocks. And then it has also caused me to still kind of be thinking this way, like, oh, what companies are kind of resilient in that scenario should that actually play out, which I'm probably not perfectly positioned for. Like, I'd probably like to strengthen that aspect of my long-term portfolio more. But quite frankly, like, I don't always find it easiest to find the businesses that will benefit from higher rates.
And that's why I think Trump will be good for the economy. Where did we start there and where did we end up, man? That was a journey of an answer.
Yeah, sorry.
Thank you.
Well, I did preface it by saying I'm the ADHD kid at the adults table. So that's what I was thinking, okay?
It reminded me of the memes that went around after the Tucker Carlson interview with Putin. It was like, what do you think of the economy? It was like, well, in 1257 in a village in Ukraine. I was like, wow, this is the longest run-up I've ever seen. Love it.
I'm completely unaware of those memes. I haven't been on Twitter, so
you're missing out.
I'm kind of glad I'm not hearing about Tucker Carlson Russia interview memes.
Well, it's wild, is all I'll say. And whatever other quick thing I'll just slip in before we move on from central banks is, I don't know if you guys saw the clip from the Kiwi.
Yeah, I don't know how I like about being likened to Vladimir Putin. Then that's a harsh one, man.
Just in verbosity.
That feels harsh. Yeah,
we all, not that I can talk. Yeah. Did you see the clip from the central?
Sorry, this is Central Bank of New Zealand, was it?
Yeah. The RBNZ said something about, one of the great things about being a central bank is we can just print all the money, and like, for whatever reason, people still believe it. And like, everyone laughs around the table and they go on. Is this one of those peek behind the curtain kind of moments where everyone's gone, it's like the Leonardo DiCaprio meme with, from Once Upon a Time in Hollywood, pointing at the TV. He said it. Anyway,
I can just imagine that 10,000 people you follow on Twitter all echoing that in a little Bitcoin echo chamber.
Oh, we sure did.
We'll move on.
Oh, we did.
We had a question through about Ava Risk Group. We actually had a couple of people commenting on Twitter about this one because we've talked about it. We picked the really big, well-followed stocks just to get our listener numbers. And no, I'm just kidding. It's like the least. It's just weird we have so many people asking about it because you've talked about it so many times. Anyway, hi guys. This is probably by the time you get to discussing this, we'll have more info. Wondering if you can break down this is last Friday, Ava Risk Group announcement. Seems like they released a half-baked announcement of an agreement with Telstra. The market went crazy. Then they issued another release to clarify the agreement details. And the second ASX announcement was still a bit wishy-washy. Essentially said they don't have any guarantee of a financial outcome before then going into a trading hold. Is this a case of being too keen to hit the send button on the first release? Is it not a bit amateurish to send out a half-baked first announcement? I know it's a well-supported small cap, but is this a red flag? What do you think, Andrew? You've followed this one a fair bit. What were your thoughts?
I'll just say, I don't think it's well supported. Yeah. And, no one likes it. I mean, this is a masterclass in how not to do investor relations. You start with, I would say, demonstrably good news, and you suffer in the way that you communicate that to the market. So the TLDR on this is that they signed a contract with Telstra to use their fiber optic network. Well, in fact, to use Ava's tech on their fiber optic network to monitor for security, safety, uptime, all of that kind of stuff. And it was a bit vague. But Telstra is obviously a very big customer. This was a use case for their technology that hadn't been promoted before. So it's a whole new adjacent in a very, very large industry that has, and a contract that came about after, I think it was 12 to 18 months of negotiations, trials, etc. It's great news. However, they can walk away, I think, with 20 days notice. There's no minimum spend commitment. Look, when you're an ant and you're negotiating with an elephant, the elephant gets the better part of the contract. Okay, so I don't think that's necessarily a bad thing. And without it, no one had this on their radar anyway. So it wasn't as if the market's just waiting for this contract for Telstra to come through and then it'll be fantastic. No, it wasn't. Well, no one had it on their bingo card. It comes out of left field, but they are more vague than they need to be. Rather than just spelling out, hey, listen, we can't give you any financials because we don't know how much it will be, but we can tell you some facts, i.e., there is a termination notice of this length. There is no minimum spend. Just clarify. And I think had they done that and they had been a bit smarter with that, we actually saw a 20% pop on the day, and now it's not really that far off where it was pre-announcement. And I think that the market would have reacted to it much better. Look, for my sins, I tend to think it's good news, and I think the Ava and the board really just handled this awfully bad, but not in any nefarious kind of way. But I tell you what, if they were to make the same mistake again, I would change my view radically on that. And I know that we're speaking to the CEO again next month. To their mind, it's like, we've been putting out a lot of good news and no one cares. And they get this and they go, oh, look, everyone, look what we did. It's like, wait a sec, what's this? It's not very clear. The ASX is now using the word ramping in their announcement. Like, whoa. No. We're just happy about this announcement. And maybe people can interpret that in very different ways. I'm sure many will. But I don't know if this represents a long pattern of behavior that like clearly stinks of intentional ramping. But that's my 2 cents.
Did you have any thoughts on that one, Claude, or hadn't looked at it too much?
Yeah,
Claude is not going to have a sympathetic view of this.
I have nothing further to add. I have no idea. Yeah, I feel like those sort of unquantifiable announcements are like always super annoying, and I'm happy the ASX is.
But what do you do, man? Well, do you not announce it? Do you sign a contract?
Mate, it's far from the most egregious thing I've ever seen. Trust me.
They have to announce it. If their view is that this is material, they must announce it.
Yeah. They just have to say,
view, right?
I thought their response to the ASX's query was reasonable enough. It's one of those situations. The ideal thing is you say, hey, we've done this thing. We hasten to add, there's nothing guaranteed from it yet ever, either. And the reason is it's because it's good to see that the ASX has learnt from GetSwift, right? Because that was the ultimate one of it. Because it was all super explicit. It was they were like, we've signed this contract with Amazon worth X number, or we've signed all these different contracts and these person have so many thousands of transactions. And then you had articles that were published on Motley Fool, using this to try and calculate how much revenue that might be and coming up with large numbers. And actually none of it was guaranteed at all. But what GetSwift's announcements did is they gave enough information for someone who was insufficiently cynical to like just come up with like ludicrous conclusions. And so now what the ASX is doing is to try and discourage that kind of possibility when people like give like what AVA did, whether they're like, there's so many 100,000 bits, kilometers of fiber, and we've signed a deal with it. And the risk is then you get some enterprising fellow to like be like, oh, if I times that number by how much each device costs or whatever, then I get up with, 50 million or whatever, and then start publishing that. And then people are buying shares thinking it'll be 50 million. And so that's pretty much all I think of. But in terms of like the mistake they made, which was to not include a better announcement the first time. Yeah, as I said, I've seen far, far more egregious stuff on the ASX. So
Yeah.
In any week, probably in any week. And there's scarcely a week would go by where something worse than that doesn't happen on the ASX. So it's not that bad.
I'll give a shout out to one of our members, Bear77. He laid out the template for any companies and any IR people that are listening. Really simple, guys. Suspend your shares, okay? If in doubt, just ask for a pause in trading, right? Get together, think about it carefully, write out everything that you can disclose that is not commercially sensitive and that any reasonable investor would want to know. Anything that you can't be certain of, say you can't be certain of it, right? Just give us just the facts, ma'am. Just the facts, right? And then make sure the lawyers have a look at it. Take your time. Take 2 days if you need to. Take 3 days and then release it. And that is how you do it. You don't release a half-assed announcement. I think it was actually during trade or maybe just before trade, and then a follow-up, and then a pause, and then a clarification. Like it's just a disaster. Now,
well, yeah, but it's because they got that happened. The disaster happened was because they did this half-assed announcement, and then as soon as that happened, things got out of their control. So, like, and that was because that somebody at the ASX had a look at their announcement and they were like, hold on a second, you're giving us a quote about more than 5 billion kilometers of fiber optic cable in the world, and you've signed an agreement, you're saying, with 250,000 kilometers of fiber optic cables, 8,200 mobile towers, you're giving us all this big number data, but then you're not saying and how much revenue is likely to get, and it's just sort of like dazzle you with big numbers approach, which I think the ASX, whoever did that, whoever was like, wait, you don't just do this dazzle with big numbers thing anymore without giving us something tangible about how much it's actually worth. I say good on them. They did a great job. They did their job well that day. And then the rest is like, seems like AVA handled it best they could after that as well.
Nice. Yeah. Well, let's go to another question we had come through. This was one that was sent to you, Claude. Do you want me to read it, or I've got it in front of me from James?
Yeah, you read it out.
G'day, Claude. I don't know how it slipped by me, and don't think it's got a mention on the podcast, but Volpara got a takeover offer in December. Would be interested to hear your thoughts, and especially if Matt has anything to say about a Kiwi company being plucked away before it hit its straps. Don't have to go far back to be at prices well above takeover, but has been a bumpy/disappointing couple of years. Hope your New Year's has kicked off well. Yeah. Do you want to, what did you guys have any thoughts on Volpara?
Yeah, I'm salty that I didn't own shares when the takeover was announced.
But you're glad you didn't own them for the years before that.
Well, I did own them for years, and then I sold them like at slightly below the takeover price, actually. So I would have been better if I just held it on for the ride, probably. Yeah, I also think there was an obvious setup there. Like, we knew it was a pretty good company. It was getting to cash flow positive. The new CEO had come in. She'd done pretty good track record getting there to cash flow positive. And then it was pretty much borderline or crossing over into cash flow positive software company with a massive chunk of recurring revenue. Yeah, the recurring revenue growth had slowed down a bit. That was probably the reticence. But I've really beginning to notice a pattern, and I'm surprised and disappointed myself not to have really made any money out of this. But there's been quite a number now, and it's potentially over, I don't know. But there's been quite a number of software companies. It seems the companies with a decent chunk of recurring revenue, doesn't even have to be that high, plus turning over into cash flow positive, they've been the ones picking up takeover offers. And Volpara ticked those boxes. And yeah, I wish I'd taken advantage of it, basically.
Do you have any thoughts, Andrew?
I always liked the company. Spoken to the CEO a number of times. It was always, I guess I struggled with some of the valuations, but yeah, great Great company. It's a good reminder too. I think that there is. I was going to say, usually all good things to those that wait. If you are legitimate in your assessment of value, it can take a long time to sort of be realized. But even if the catalyst for that is an outside party coming and going, no, we will pay much more for market price for that, and still be happy with it.
Well, I don't think it's a massive success story, right? Though, because in 2019 this was at $1.80.
No, I disagree.
Yeah, in 2018 it was like $1.40 or something. That's what I mean.
Yeah.
But the company doesn't control the share price. I mean, I would say if you were to look at their revenue growth, the penetration that they have made into that market, there wasn't really any egregious capital raisings there. I mean, you go back even to I'm just looking now, 2020 was still 220 million shares outstanding versus 254 today. You know what I mean? Like, it's not. I have sympathy for if the company has had a bad share price performance from a given point in time because they were overly exuberant in pumping that price out, then okay, they're responsible. If the market's gotten a hold of something and just raced it to the moon, it's like, imagine you're the CEO. It's like, what do? Do you come out as the CEO with the support of the board and say, oh my God, the market is crazy. We are so overvalued right now. However, the business is performing well. We expect to continue to grow, etc. Like, you don't do that.
I don't think it's anything. I don't mean anything bad on the company. I just mean as for an investor, I just think it's a sign of how overvalued things and valuation matters.
Yeah, totally agree with that.
It was a very valuation didn't matter phase.
I think the overall story of Volpara is one of success. They did list around 50 cents. They did have a very small business when they list. They really did grow that business. And a little less than 10 years later, I think, and they were getting taken over at more than double the price. So I think on the most zoomed out level, it has been a success story. I think that it definitely got super overvalued. And as it turned out, like, that was probably the time to sell and walk away. The share price was around $1.80 until in early 2020. Actually, funnily enough, not in April 2020, I think it was, not long after the COVID thing hit, they did a capital raising, and then that was at $1.30, and they called that capital raising when the share price was about $1.45. And then after that time, since that capital raising, they did a little bit briefly trade higher, but they essentially traded lower until being taken over. So that's a 4-year run, really, where like you probably would have been better off sitting out of the whole story. So yeah, it goes to that overvaluation point, really. The other final thing is actually it's quite possible Volpara could have gone on to achieve greater things on the ASX. We might be missing out on something good there. So it's probably a little bit sad about it for that reason. Yeah, I guess that leads us to Ansarada, which followed this pattern actually. And this is like another one of those sort of little ideas. You don't even have to come up with every idea yourself. I had a friend essentially point out to me that the M&A market was clearly heating up. Like, we've seen it all around us in the last 6 months, and that is good for Ansarada. And on top of that, they were going fairly well with their go-to-market strategy, which they'd tweaked. So there was a nice little combination of those two factors. So I highlighted it after the most recent quarterly as one that I liked, and even commented, given this is a cash flow positive software company trading around 3.5 times 2023 revenue with the likelihood of growth, I think there's at least some prospect of a takeover offer. Well, I obviously underestimated that because the very next day it got one too at a fair bit higher price. So yeah,
that's good timing though, Claude. I bet you're glad you didn't wait a day to right there.
I'm glad I published it when I did. At least now I got bragging rights. But really, what I want to do is be able to, like, when I get these little ideas, when I see the quarterly, just be like, oh yeah, cool. All right, I'm going to put some money after that and not really tell anyone about it. And then if it works out, great. And if I'm like, turns out didn't work out, I'll just sell it. And it's not super high conviction stuff, but it's like just this little pattern recognition thing. And that was the pattern that I'm telling you that I've really noticed and I've been noticing for a while. So I don't know how much longer that has to play out, but it definitely gets me thinking. I think that's why I did, what was it? There was like another company that it sort of maybe categorized, like, that look a bit like that. I'm kind of interested in those companies, but also,
what would you say the pattern is, Claude? It's like a software company, that's like hitting profitability.
So no, I'd say like a knocked down software company, like that is trading on around 3 to 4 times revenue, and their revenue is of, like, it doesn't have to be perfect, but of reasonably good quality.
Yeah, cool.
So I think in hindsight, like, Volpara had pretty high quality revenue. So it was probably, a more obvious one, basically. It was down at 50 cents for a while. Like, I feel like that really, if I'd cottoned onto this pattern. That's why Volpara really stings, because like I think it was a great fit for that pattern. And then like Ansarada, kind of decent fit as well. There's others that like might be getting close as well. I don't know, like somebody email me or tweet me if you know of other companies that fit that pattern.
Yeah, I think that's a good idea. Yeah, I guess I think that's a fair one too, because these are quality companies as well. It's not just, I'm always reluctant to own companies just on the expectation of takeover, especially when they're not performing well. If they're not performing well, because then you end up, if the takeover doesn't happen, you end up owning companies not performing. But these were kind of doing okay, high quality revenue, etc. So I can understand that case a bit better.
Yeah, not the highest perfect recurring revenue. Volpara's was pretty good. That was probably the pick of the litter. But yeah, still decent quality revenue, like high margins, if not perfectly recurring.
Interesting thing with Ansarada too is there's this carve out of several of the business lines, which will be owned by Sam Riley, the CEO. He's buying them for $500,000, I think, which is just kind of a really interesting, I guess he wanted to go ahead with those businesses. The acquirers didn't want them because they're burning cash. Yeah, so Sam Riley has agreed to acquire the carve-out assets for $500,000. Yeah, which is like the ESG business. There's a couple of other kind of newer product lines that are being carved out. ESG, GRC, and board businesses. So yeah, interesting way to get the deal done.
Yeah, that guy might be an interesting businessman to watch.
Yeah. Do you have any thoughts on Ansarada, Andrew? Had you looked at that one before? Or?
I'm not familiar. No, sorry. I'm not going to add any. Well, as people well know, I'm not going to contribute anything intelligent to the conversation, but especially on this one.
Yeah, excellent. All right, maybe we wrap it there, gents. Do you have something you're grateful for, Andrew? I think we're just trolling Andrew this time. Every week we're just asking for an actual positive thing.
One of these days we'll finish the podcast and then just let it run for now. I'm going to give the most God almighty rant on this.
We'll have a bonus episode. Which
property
is
Ponzi BS crap that I'm going through right now. And I think I'm going to miss out on a house because of these illiterate box ticking, window leaking numpties. But other than that, things are really great. But, I'm thankful for Bitcoin. Thank God for Bitcoin, because that's on a pump, and that things would be a lot darker without that.
Okay. Well, that's a genuine
okay.
He's genuinely grateful that the Bitcoin price is on a tear.
That's actually true.
Well done, mate. Who doesn't love some money? Well done. Congrats on your money. Look, maybe you should sell the Bitcoin to solve the house problem. Just a thought bubble.
Andrew's on mute, which I think is better for everyone.
I sense he's disagreeing.
And another thing. I was just going to say, why am I selling the world's best money for crappiest money? Okay, back in your box.
Live in the Bitcoin. Okay, Claude, what do you have to be grateful for? Anything you wanted to?
Oh. So much. Oh yeah. Okay. This was obviously health, happiness. Yeah. Health, happiness, family, friends. Happy to get to chat to you guys. But my idiosyncratic one is I really enjoyed watching The Lion King with my son the other day.
Oh, nice.
For the first time watching him. That was my favorite movie as a kid. Well, so the first time I attempted to show it to him, it was a bit young and we didn't get past the first scary bit. And then he had an aversion to it after that. Yeah. He was like, it's scary though. And I'm like, yeah, but I showed it to you when you were 2. I got overexcited.
Just wait till he's a bit older and then he can sit down and watch Bone Tomahawk with him or something like that. So I'm like, that's my threat to my 14-year-old.
I remember as fondly as the Lion King, I confess.
It's an excellent movie, but it's not for the weak stomachs. I'll say that much.
Anyway, so now I heard, this morning him singing the words fairly well remembered of Hakuna Matata, which I have to say was real nice.
Yeah, nice, man. That's awesome. Mine was I am very grateful to live in a society that works. And I guess one thing that happened was I joined the committee for this community kindergarten, like a community run kindergarten. And I don't know, it's kind of cool going along and just seeing all the boring stuff that works to make those things, everyone's going through the motions because they're only on the committee for a year, but doing all the things that are boring but kind of work. I don't know, it's kind of cool and just very cool kind of group there. So yeah, that's my little bit of gratitude for this week. Cool. All right, we'll wrap it there. Hit us up on Twitter at BabyGiantsPod. Particularly if you find any other companies that are about to be taken over, let us know beforehand. I don't think we have too much else. And until next time, thanks very much for listening.
Thanks, everyone. Have a great day.